you've listened to any of our videos or followed any of the things we talked about, we've always gone over negative closing cost loans, getting a lender credit so that the lender pays you to refinance. And we've started to get a bunch of questions about it. And I figured that it would make sense to kind of give you an example to look at so you know what a negative closing cost loan looks like. So here's an example where the borrower is applying for a $621,300 loan amount, has the interest rate, has the monthly payment, and then you see in the closing costs, it's 0.00. And so what this document is a closing disclosure. It's basically like the final figures. And so you see the closing cost is 0.00. So the borrower paid no closing costs. Looks like they're getting a cash back of 1948. That's just because their new loan amount is 1948 higher than their current amount to pay off their current servicer. What you can do, you can get up to $2,000 cash back. It's called a limited cash out. There's no penalty for taking out $2,000. So they took advantage of that and get a little cash back without any cost of the loan being considered a cash out refinance. But the focus here is the closing cost being 0.00. And not only are the loan costs 0.00 as the like the fees being paid for by the lender credit, but then the other costs are also 0.00. So here, prepaid interest is 0.00. Every day you have a mortgage, you owe the lender prepaid. You owe a per diem interest rate. So either you owe your current servicer that you make your payments to presently a per diem interest, and that's shown in the payoff statement shown here, or you owe the new lender a per diem interest. And so what happens when you refinance is you prepay the interest until the end of the month, and then your new loan, the first payment on your new loan starts 1 month following. So the first payment on this new loan isn't going to be due until August 1st. So that's actually not a fee. If they did not refinance, they would have owed their current servicer interest on every day from 6/8 to 7/1. So they're actually using a lender credit to go towards something that they would have paid regardless. So it's almost like the lender is paying them $1,041 because they would have had to pay interest on their mortgage regardless. And then this is what's really exciting. So if there's any excess lender credit, that has to go back to you. And so the way it goes back to you is it actually goes back as a principal reduction. So here you see $249.75 is a principal reduction. So even though they're applying for a $621,300 loan amount, you're actually going to start with a $621,050 loan amount because they're getting this principal reduction after closing. So it's really the lenders paying them. If you think about it, this 1041 plus the 249, the lender's paying them that amount of money to refinance their mortgage. And so a lot of people have the opportunity where they can lower their interest rate and have the lender pay them to take a lower interest rate. And as you can see, the APR on this loan is obviously going to be 2.625, the exact same as the interest rate, because the closing costs are 0.00. So if there's no closing costs, then the APR is the exact same. Really, though, it should be a negative, even or less than the because they're actually getting paid to refinance with that principal reduction. So that's just an example of a closing disclosure that has negative closing costs. And right now, there's probably 10 million homeowners who could lower their interest rate and have the lender pay them to do so. So if you're one of those homeowners, just go to sellfi.com and see how much you'd be able to save.